Okay, let's dive in. We talk a lot about LLMs, getting good at coding, writing, even logic puzzles. But today, we're putting them through maybe the ultimate test, high-stakes human forecasting, venture capital.
Right. This is a world built on, well, sparse signals, huge uncertainty. Human intuition is supposed to be king here, or so we thought. The mission for this deep dive, for you listening, is really one question. Just how good are the top experts at picking winning startup founders early on? And can AI actually beat them? That's precisely the goal of our source material today, this benchmark called VCBench. It's really the first serious attempt to create a large-scale, standardized, and this is key, anonymized testbed. The whole idea is to see if LLMs can match or maybe even surpass human reasoning in picking winners before they even start, just using pre-founding data.
And honestly, before we even get to the AI, the human baseline here, it kind of sets the stage. So it was pretty sobering. If you just look at the average like the market index criteria, the precision is a miserable 1.9%.
Yeah, it's incredibly low. Think about that. Fewer than 2 out of 100 startups picked using standard metrics actually succeed in a big way. It's just, yeah, a graveyard, like you said.
And the elite. The tier 1 VCs, the big names everyone knows.
They do better, definitely. They hit about 5.6% precision, so that's nearly 3 times better than the index. Still, not exactly knocking it out of the park.
Right, 5.6% is still, wow. Even Y Combinator, often seen as, the gold standard for early stage.
They clock in at 3.2% precision. That's about 1.7 times the index. It just hammers home how incredibly uncertain this whole game is, even for the very best.
Those numbers are really humbling. Okay, so if the best humans are struggling to consistently get past, say, 5 or 6%, what happened when they pointed the LLMs at this VCBench dataset?
This is where it gets really interesting. The LLMs, they didn't just meet the human benchmarks, they kind of blew past them.
Yeah.
The top-performing model actually showed a 3.2 times improvement over that basic 1.9% market index precision.
Wait, 3.2 times the market index, not just times the tier 1 VCs.
Times the market index, yes. We're talking about a potential step change in a field that's historically been driven by networks, gut feelings, human intuition.
Wow. Okay, that's a huge claim. And it hinges entirely on the data, right? This VCBench dataset. Building that sounds like it was a massive undertaking itself. We know it's based on 9,000 anonymized founder profiles, covering a big chunk of the U.S. early stage scene from 2010 to 2018.
Exactly, about a fifth of the relevant population. And you're right, the difficulty in creating this data set is a story in itself. You can get tons of data from places like LinkedIn or Crunchbase, but it's notoriously messy. Abundant, sure, but just fundamentally irregular.
What kind of messy are we talking about?
Well, a couple of big things. First, format irregularity. 20 different ways people write Master of Business Administration.
Yeah.
MBA, Master of Bus Admin.
Right. Standardizing that alone sounds like a nightmare.
It is. And second, entry irregularity. Profiles are full of non-formal stuff. Things like intern listed as a job or maybe course completed. That stuff muddies the waters if you're trying to predict formal success.
Okay, so the VCBench team basically had to become data detectives before they could even think about predictions. They built this multi-stage pipeline: standardization, filtering,
enrichment, and then that crucial anonymization step. Yeah, it was intensive.
How did they tackle that standardization, getting all those different ways of saying the same thing lined up?
They used a mix, some deterministic stuff, cleaning up spaces, mapping common aliases, setting clear standards. Like MBA always becomes Master of Business Administration. But the really clever bit, they used LLMs to help clean the data for the other LLMs.
Hold on, using AI to prep the data for the AI test. Explain that.
It's pretty neat. They use an LLM specifically to flag those informal entries we talked about, the intern roles, the coursework mentions. Things that aren't really formal professional experience.
Ah, I see. So the LM acts like a filter first.
Exactly. It flags them, they get removed. This ensures the final structured data only contains relevant formal history. It distills the profile down to the stuff that might actually predict success.
That's smart. Strip out the noise first. So what were the key fields they ended up using for the actual prediction task? What core information remained?
They focused only on things known before the company was founded. So the specific industry the founder was in, any prior big wins like IPOs or acquisitions they were a part of.
Very detailed education info. The degree, the field of study, and importantly, the QS university ranking.
University prestige matters. Okay. Seems so. And then detailed job records. The role they held, the size of the company they worked at, how long they were there, and the industry of that company. That's the raw material.
Got it.
So highly refined data, but then comes the real challenge, right? Preventing the LLMs from just cheat precisely.
Yeah.
The leakage threat. If an LLM has been trained on, well, basically the internet, it might recognize a unique pattern. Like, oh, someone from this specific top university who worked at this niche company in this industry. I know who that is.
And if it identifies the founder, it's not predicting, it's just recalling information it already saw. The benchmark becomes useless.
Totally useless. It would measure memorization, not prediction. So they had to build this anonymization defense strategy.
Okay, removing names and company names, that seems obvious, but how do you hide identity while keeping the career pattern intact? It sounds tricky.
That's the core innovation. They did it at the dataset level. Instead of exact start and end dates for jobs, they converted them into duration buckets. So rather than November 2014 to February 2018, it might just say duration, 4 to 5 years.
Okay. Preserves the length of time, but obscures the exact when.
Exactly. It keeps the career trajectory signal, but hides the specific timeline that could link back to a real person. They also clustered industry labels into 61 broader groups, again, reducing specificity to prevent identification.
But wait, converting dates to buckets, grouping industries, aren't you potentially losing valuable high-resolution information there? Isn't that diluting the signal you need for prediction?
That's the trade-off. You absolutely hit it. It is a trade-off. The key insight or bet they made was that the pattern is more predictive than the precise details. You know, the sequence of roles, the duration in each, the kind of industries, the educational background, that pattern holds more predictive power than knowing the exact start date was November 1st.
And they had to prove this anonymization actually worked, right? They couldn't just assume it did.
Oh yeah, they tested it rigorously. They basically sissed other powerful LLMs like DeepSeek and Gemini 2.5 Pro on the anonymized data. They told the models, try to figure out who this person is, use web search if you need to. Adversarial re-identification tests.
And they focused on the successful founders for this test because they'd be the most famous and easiest to re-identify.
Exactly. They targeted the hardest cases. And the results, pretty compelling. Moving from the raw data to the final anonymized VCBench format cut down online identification by about 80%.
80%, okay.
And offline identification, where the model could only use its internal knowledge, no web search that dropped by a massive 92%.
Wow, 92%. So the data was effectively scrubbed. Ready for the main event. Ready for the showdown. LLM versus the human experts. Okay, standardized, anonymized data, LLMs ready to go. But before we get the results, we need to talk about how they measured success. It's not just simple accuracy, is it?
No, absolutely not. And this is really important for understanding the results. You have to ask, in VC, what's worse? Missing a unicorn, a huge success. That's a false negative.
Or investing in a company that ends up failing. That's a false positive.
I'd guess investing in the failure is worse. You lose your capital. Missing out hurts, but doesn't cost you directly.
Exactly. That's why VCBench emphasizes the F0.5 score. It's a metric that weights precision twice as heavily as recall.
Okay, break that down. Why double down on precision? Think about fund economics. A VC fund typically needs just a few massive winners to return the entire fund to make a profit. Missing one success, a false negative, is disappointing. You lose out on potential upside. But investing in a failure, a false positive, you actively lose the money you put in, plus time, resources. If you make too many false positive bets, your fund dies. So being right when you say yes, that's precision, is paramount.
That makes total sense. You absolutely have to minimize the yes decisions that go wrong. Okay, so with F.5 as the yardstick, weighting precision heavily. Let's see the results. How did the LLMs stack up against that 5.6% precision benchmark from the Tier 1 VCs?
The results were frankly pretty striking. The overall best performer using that F.5 score was GPT-4o. It hit an F.5 of 25.1%.
Okay. And what was its precision?
Its precision was 29.1%, and that number, the 29.1%, is what led to that 3.2x improvement figure over the market index's 1.9% precision.
Let's just pause on that. 29.1% precision compared to 5.6% for top VCs. If you're a VC, 5.6% makes you world-class. Nearly 30% precision. I mean, that's almost legendary status if a human achieved it.
It's a massive gap. It really suggests the LLM, working only with this anonymized historical data, is picking up on signals that even top human experts are consistently missing.
But did all the LLMs get there the same way, or were there different strategies?
Very different strategies emerged, actually. Take DeepSeek V3. It achieved the highest absolute precision of any model tested, an incredible 59.1%.
Whoa, 59%. So when DeepSeek said yes, it was right almost 6 times out of 10.
Correct. Almost unbelievably precise. But that precision came with extremely low recall, only 3.0%.
Meaning it hardly ever said yes. It was super cautious, only betting on absolute slam dunks it perceived.
Exactly. Very few predictions, but the ones it made were very accurate. Now, contrast that with Gemini 2.5 Flash, it went the other way. Highest recall, 69.1%.
So Gemini found most of the successful founders in the dataset.
It identified the majority of them, yes. But its precision was much lower, more modest. It cast a wider net, finding more winners, but also making more incorrect yes predictions along the way.
Interesting. So you had hyper-focused precision models and broad coverage recall models, but the main takeaway seems clear.
Yeah, the bottom line is that even these anonymized founder profiles, stripped of names, companies, exact dates, they still contain enough predictive signal for LLMs to significantly outperform established human expert benchmarks in this really complex, high-stakes prediction task.
And it wasn't just the absolute top-tier, most expensive models doing this.
No, that's another key point from the source material. Even lower-cost models like GPT-4 Mini apparently show strong performance too. This suggests the capability isn't just limited to the absolute frontier models, it's becoming more accessible.
That feels revolutionary. But okay, we need to apply the brakes a bit. These results seem almost too good. They have to be caveats, right? Limitations to how we interpret this.
Oh, absolutely. The researchers are very clear about the limitations. The biggest one is what they call the prevalence shift.
Prevalence shift, meaning the success rate in the test data.
Exactly. Remember, VCBench uses an inflated success rate of 9%. They did this for statistical stability, to have enough positive examples to train and test effectively. But the real world, that's the brutal 1.9% success rate we talked about.
Right. And performance metrics like precision don't just scale neatly when the baseline odds change so dramatically.
Precisely. A model hitting 29% precision when 9% of the inputs are successes is very different from trying to hit that same precision when only 1.9% are successes. It's like training a goalie against easy penalty kicks and then expecting the same save percentage in a real match against world-class strikers.
So that 3.2x improvement multiplier, it's impressive relative to the benchmark conditions, but we can't just assume it translates directly to a 3.2x better real-world fund.
We have to be cautious. The relative advantage over humans might hold, likely will hold to some degree, but the absolute performance numbers will almost certainly be lower in the much harsher 1.9% reality.
Okay, that's a big one. What else? You mentioned comparing LLMs to humans isn't perfectly fair.
Right, the human comparability bias. The benchmark treats LLMs and human VCs as if they're looking at the exact same pool of opportunities. But in reality, human VCs don't see every startup. They filter heavily based on their network reputation, sector focus, even just bandwidth. They can only look at so many deals. LLMs in the benchmark don't face those same pre-filtering constraints.
So the humans are playing with a potentially pre-selected, maybe harder or maybe easier deck of cards than the LLM in the test.
Exactly. It makes a direct comparison of their raw predictive ability, somewhat apples to oranges. The real-world performance gap might be different because humans operate under these real-world filters.
Makes sense. And there was one more, something about time, a temporal bias.
Yes, the right censoring effect. Success in VCBench was defined based on achieving certain milestones, like an exit or big funding round, within 8 years of founding.
Okay.
But the data covers startups founded from 2010 to 2018. A company founded late in that window, say 2017, only had maybe a year or two within the observation period to become a success, according to the benchmark's definition. Compare that to a company founded in 2012, which had the full 8 years.
So later companies are inherently disadvantaged just because they had less time on the clock within the study period.
Precisely. It introduces a bias that might favor companies founded earlier in the dataset, regardless of their actual potential. It's a structural limitation of using a fixed time window.
Prevalent shift, comparability issues, temporal bias. Definitely important context. Given these limitations, what's next for VCBench? How do they plan to make it even more realistic?
The future directions sound really fascinating. They want to move beyond just static classification, these simple yes-no prediction on a profile. The plan is to introduce a VC simulation mode.
Yeah.
Think more like a tournament.
A tournament? How would that work? Like models competing against each other? Yeah, imagine companies appearing sequentially, one after another, like real deal flow. And the model, or maybe a human player, has a limited budget. They have to decide, invest or pass. How much to invest?
It forces decisions under resource constraints, capturing that dynamic portfolio management aspect of real VC.
That sounds much closer to the actual job.
Definitely. And the ultimate vision seems to be this gamified arena, a place where human investors, different LLMs, maybe even specialized AI models built just for this task, can compete head-to-head on these sequential decisions. That would be a true test of intuition versus data synthesis in a controlled, dynamic setting. Plus, they plan to keep it as a living benchmark, updating it and using private test sets to prevent future models from just memorizing the answers by seeing the benchmark data during their training. That sounds like a really exciting path forward. Okay, so for you listening, let's try and boil this down. The big takeaway seems to be if you can standardize and effectively anonymize founder data.
It turns out there are powerful predictive signals buried in that history. Signals that LLMs, particularly when focused on precision, can leverage to forecast success with an accuracy that, in this benchmark at least, surpasses even top human VCs.
Right, and that leads to the really provocative thought here, the thing to maybe chew on after this deep dive. We're talking about a domain early-stage investing that's famously opaque, uncertain, driven by human judgment. If LLMs can take sparse, noisy professional histories data that's technically available, just hard to synthesize and predict outcomes with, say, 3 times the precision of the average investor, what does that really mean for the future value of human expertise?
Does intuition get replaced by synthesis?
Maybe,
Yeah.
or maybe expertise shifts. If the best predictor isn't just gut feel anymore, but this deep synthesis of data, does the role of the expert become less about having the intuition and more about knowing how to wield these powerful analytical tools, how to interpret their outputs, how to combine that synthesis with human judgment?
That's definitely something to think about, especially as these models get applied to more and more complex human-centric domains. A fascinating glimpse into a potential future.